Good morning, guys. You're welcome back to my channel. You're welcome back to the course. It's Financial Accounting Made Simple. My name is Sanyaolu Oluwafemi, and today we'll be looking at final account of a sole trader. Now, the final account we'll be looking at is the final account without adjustments. I have another video that talks about the final account with adjustments. So when we refer to final account with adjustments, we are talking about year-end adjustments when you have accruals, prepayments, provisions, and so on and so forth. However, for the purpose of this particular class, we would not be considering year-end adjustments. We'll only be considering only the information that is available to us in the trial balance. So let's jump right into the course. So like you always know, our course approach is that you must have an open mind. Is accounting. Sometimes students can have phobia for figures, for accounting, but in as much as you understand simple arithmetic skills like addition, subtraction, multiplication, you should not find this account too challenging. Another thing with accounting is you need to practice, just like maths. You need to get questions and practice frequently. The more you practice, the better you will become. For our learning objectives, so at the end of this particular lecture, students should have a working knowledge of the meaning of income statement, the meaning of statement of financial position. The format is very, very important. The format of preparing the final account, which is the statement of financial position and the income statement. Then we have practice questions. We're going to solve the questions. Then you have an assignment at the end of this particular course where you can try your hands on that. So final account of a sole trader. Now, when we talk about final account of a sole trader, we are talking about the trading profit and loss account. So under the income statement, you'll be required to prepare what is called the trading profit and loss account. We normally call it trading profit and loss account before, but the advent of IFRS has changed it into a statement of comprehensive income or statement of profit or loss. So when we talk about final account consists of the trading profit and loss account and the statement of financial position, which we normally refer to as the balance sheet previously, while the trading profit and loss is what we call the income statement or the statement of comprehensive income or statement of profit or loss. So the statement of comprehensive income shows the financial transactions of a company over a period of time. It's a temporary account that needs to be written off at the end of every accounting period. The importance of preparing the trading profit and loss account or the income statement account is to determine the net profit of the organization as at the end of the year. So is to look at the activities of the company throughout the course of that particular business. Now, other titles that we refer to, you can see sometimes I call it comprehensive income statement, sometimes I call it statement of profit loss, sometimes you might call it statement of operations, statement of profit or loss, or the comprehensive income, statement of comprehensive income, statement of income. So whichever name you use, you will all still be correct. So let's look at preparing the trading account. What does it mean to prepare the trading account? Now, the trading account is prepared usually to determine the gross profit or loss. The trading account of an individual is usually prepared to determine the gross profit or loss. Now, how do we normally determine the gross profit or loss? The gross profit can be determined when you have sales less your cost of goods sold. So when you have sales less your cost of goods sold, you'll be able to determine what your gross profit is or sales less cost of sales, as the case may be. Now, our cost of sales is a function of three major things. It can be more comprehensive than that, but let's just look at these three components first. The first one is you have a beginning inventory. So what is an inventory? An inventory is an item of stock that exists at a particular point in time. So you have the beginning inventory, you add purchases of new inventory. So the beginning inventory that you have at the beginning of the year. So for example, we had inventory from last year that we did not sell. That particular inventory will be transferred to the current period, and any other purchase that has been made in the current period will be added to the closing inventory of the previous period. Then we'll now deduct the inventory that we have at the end of the year. So using that simple calculation, you'll be able to determine your cost of sales. So your cost of sales is also referred to as the cost of goods sold. So let's continue. We have purchases. Purchases represent inventory that has been purchased by a business or that has been bought by a business with the intention to resell. So anytime you hear purchases, purchases are item of stock. They are inventory that have been bought by an organization for the purpose of reselling those items. Then we now have returns outwards. Now, return outwards are goods that we've previously bought from our suppliers. So those that usually supply us with products, they are goods that we've probably bought from our suppliers, and we realize that some of them may not meet the specification or the requirement, or may be defective, and we might decide to return those goods back to the supplier. So for example, we purchased goods worth 10 million, and we now realize that 2 million worth of inventory, 2 million worth of goods out of the 10 million that we bought are not usable, or they don't meet the required specification of our business organization. So what will happen is we have to return those 2 million goods back to the supplier. So that's what we refer to as what? Returns outward. They are goods that we previously bought for the purpose of reselling those goods, but because of the challenges that the goods may have, maybe the wrong color, maybe the wrong specification, it might not be the right quantity, it might not be the right size. This has now made us to return those goods. So let's continue. Then we now have sales. Now, what is sales? Sales are the value of goods and services that have been sold by an organization. So when we bought goods for the purpose of reselling, the part of those goods that were bought that have now been sold is what we refer to as sales. So an organization would now use that money in order to be able to determine the value of sales. So sales are goods that have been bought but have now been sold. So the value of those goods that have been sold is what we refer to as sales. Now, it is possible, just like when we make purchases, it is possible that some of our customers that have bought goods from us may not be satisfied with the class or type of goods that have been bought. It may not meet their specification. There may be shortage in quantity, maybe the wrong color, maybe the wrong size, and these customers may have decided to return the goods back to us. Now, that is what we refer to as returns inward. Returns inward represent goods that have been previously sold to customers but have been returned for one reason or the other. So the next term we're going to look at now is carriage inward. So carriage inward represents the cost of transporting the goods that we bought, the goods that we've purchased from the supplier, the cost of transporting them to our current location, the cost of bringing them to our warehouse is what we refer to as carriage inward. And this cost will form part of the cost of the product. while carriage outward represent the cost of delivering goods, the cost of transporting the goods to our customers. So any cost that is incurred in transporting these goods to our customers is what we refer to as carriage outward. Now note that carriage inward will be treated in the trading account, while carriage outward would be treated in our profit or loss account. So I'm going to show you how we do that later in this presentation. So we have a format. Now, let me advise you, the best way you can understand the final account of a sole trader is to be able to memorize the format, to be able to reproduce the format. So you must learn the format to be able to reproduce the format. Now, in the format, the first item we have is sales. The first item we have is sales. Don't forget, sales are goods that have been sold for which value has been received. So the first item we have there is sales. Now, the next item we have under sales is called sales returns or returns inward. Now, returns inward represent goods that have been previously sold to our customers but have been returned. So at the end of the day, if we calculate the goods that have been sold and the value of the goods that have been returned, the balance is what we call the net sales. So this balance here is what we refer to as the net sales. The balance here is what we refer to as the net sales. Then the next thing will now be to determine our cost of sales or cost of goods sold. So after we have derived the net sales, the next thing will be to determine our cost of sales. Don't forget, I told you that there are three major components in determining cost of sales. You have your opening inventory, that's your beginning inventory. You add your purchases, and you less your closing inventory. But that's just for a simple trading account. So this one is a bit upgraded. So the first one we have is the opening inventory. That's the inventory we had last year that we could not finish selling. We have to bring it up to this year. So we'll sell that first. So we have the opening inventory. Any inventory that we've purchased in this current period will be added to the opening inventory. So let me assume we had 1,000 units of inventory last year that were unsold. We're going to carry that 1,000 units of inventory into the new year. And then if we now decide to add additional 20,000 units, so that 20,000 units will be added to the 1,000 units. So for this particular period of time, we have 21,000 units. Then we now add our carriage inward. Don't forget, I told you the carriage inward represents the cost of bringing goods to your current location. So we add the carriage inward and we less the carriage outward. The returns outward, rather. We less the returns outward. Now, what is the returns outward? Returns outward are goods that were previously sold to us by the supplier, but because the goods do not meet our specification, or they are not of the right quantity, or they are of the right color, or the right standard, we have decided to return such goods. Another name for it is purchases returns. So that value of the purchases return will be deducted from the value of the purchase, and that would give us our goods that are available for resale. That will give us the goods available for resale. Now, if we deduct our closing inventory from that, that should give us our cost of sales. So that will give us our cost of sales for the period. So if you deduct the cost of sales from our net sales, that will give us the gross profit. So it's a deduction of the cost of sales, of cost of goods sold, from the net sales. Don't forget, our net sales is a function of sales less sales returns or returns inward. That will now give us the gross profit, as the case may be. There's a note below here. Note that the cost of sales does not include selling expense, general and administrative expense. All these would be treated in the profit and loss account, or the profit and loss account. So let's look at the profit or loss account. Now, what is the profit or loss account? The essence of the profit or loss account is to determine if the organization or the individual has made a profit or loss. So the profit and loss account is prepared to determine the net profit or net loss, as the case may be, for the accounting period. So how do we normally determine if there is net loss or there is a net profit? We are going to be looking at that. So the first one is net profit. Now, net profit is a function of our gross profit plus other income. I'm going to explain what other incomes are. Then we less our expenses, the expenses that we're talking about in the previous slide. That is the general and administrative expenses. So what are expenses? These are cost of goods or services that are not related to the products, that are not related to the cost of the products. So we have indirect expenses that may not be directly related to a product. And as such, these indirect expenses will definitely have an effect on our total cost. So I'll give you an example. The cost of electricity. So if you manufacture a drink, the cost of electricity or the cost of warehousing or keeping those drinks would have been channeled into the per unit of that particular product, so as to get the accurate picture of how much that product truly costs. So that is expenses. Then for other income, now other income are revenue that are generated outside the normal sales of the business. Don't forget, in the trading account, we talked about sales, and sales there represents the amount of goods and services that have been sold to customers. But when we talk about other income are the revenue that are generated by an organization that is outside the goods and services that are being sold. So for example, the organization keeps money in the bank and generates interest. That's bank interest as a result of saving money in the bank, or they have an investment in another company that is giving them dividends, or they've bought in large quantity and the supplier has decided to give them a discount on the bulk purchase. All these represents other income. Then lastly, the net profits. Now, how do we normally determine net profits? This is very simple. Our net profit is a function of the net income less our cost of sales. So we have the net income less our cost of sales. Now, how do we know if we make profit? We know if we make net profit if our income is higher than our expenses. So if our income is, say, 2,000 and our expense is 500, that means we'll have a net profit of 1,500. So that's how we know if we have made a net profit. On the other hand, if our expense is 1,500 and our net income is 500, that means we've made a net loss of 1,000 naira. It's as simple as that. So whenever the expense is more than the income, you make a loss. Whenever the the net income is greater than the expense, you make a profit. So let's look at a comprehensive income statement format. You know, we looked at the trading account format. So this is the income statement format. Now, you would notice that at the beginning of the income statements, you have headings. The headings are very, very important to the account. So you must always have your own headings. So you can see the headings consist of the name of the organization, as the case may be. You can see this is for DJ Femzi Business Enterprise. So the name of account needs to be included in the account you are preparing. Also, you need to have a name for the account you are preparing. So in this case, we are preparing a statement of profits and loss account for the year ended, 31st December 2022. That means the year is supposed to end 31st December 2022. So most times the year end would have been given to you in the question. So you follow the year end that have been provided in the question. So let's continue. The first item we have there is sales or revenue. So in some accounts, you see it as sales. In others, you see it as revenue. In some, you may see it as turnover. They all mean sales. So sales, you have your sales, then you less your sales returns. We treated this when we looked at the trading account. So you have your sales, you have your less sales returns. So if you deduct that returns from the sales, you will now have your what net sales. Like I said, this format, you need to memorize it. The next thing is to determine our cost of sales. Now, how do we determine our cost of sales? We have the opening inventory. You add purchases. If there are any purchases that have been returned or returns outward, you deduct that. You can see all those letters that are in red means subtract, while the black ones means addition. So if you deduct your sales return, it gives you a value. Then you now add carriage. Don't forget, we said carriage inward is cost of transporting goods to their current location, and it will form part of the cost of that particular product. So we add carriage, then we now deduct inventory, closing inventory. The closing inventory will always be given in question. In fact, 99% of the transactions we'll be dealing with will be given in the question. It's as simple as that. Then the last one is add wages. Now, there are different types of wages that you might see in the question. Now, where you see ordinary wages, when you see just wages, that wage relates directly to the product. It means you are supposed to add it to the cost of sales. It means you add it to the cost of the product. But where you see wages and salaries, or where you see just salaries, this should be treated as an expense. But when you see just wages, wages will be added to the cost of the product. That means we are talking about the direct wage that relates to that particular product. So if you deduct our cost of sales from our net sales, we are going to have our gross profit. Now, after deriving the gross profit, you add other income. I've explained other income. Other income are income that the organization derives from outside the sale of goods and services. So this may include rental income, dividend, bank interest, discounts received. All these are rental income. All these are income to the business. So you add that together, that will give us our net income. So after deriving the net income, we less expenses. Expenses include transportation expense, they include carriage outward, the cost of transporting goods to customers, depreciation, that's the reduction in the value of an asset. We can see wages and salaries. You can see salaries all deducted as expense. Don't forget I said wages, where you see wages alone, it will be treated as directly related to the products. Then we have discounts allowed, rents, etc. You could have other expenses. So if you total the expenses and deduct it from our net income, we will have a gross profit. That is if and only if our net income is greater than our expenses. If the expenses are greater than the income, that means we are going to have a loss. So that's that about comprehensive income statement. So let's look at statement of financial position, normally referred to or previously referred to as the balance sheet. Now, the statement of financial position shows us the asset, liability, and owner's equity that has been contributed to the business as at a particular date. is a snapshot of the asset, liabilities, and the owner's contribution to the business as at a particular date. It is a permanent account that will be carried from one accounting period to another. It is a permanent account that will be carried from one accounting period to another. So then we now have the elements of the financial statement. Now, what are the elements of the financial statements? You have the assets, liability, and capital or owner's equity. The assets represents the value of the company. Yeah, the values, claims, and possession of the business that are being controlled by the business. So if you have not watched my video on accounting equations, I extensively explained the meaning of assets, liabilities, and capital or owner's equity, as the case may be. Now, what are liabilities? Liabilities are financial obligations that the company owes to individuals and other organizations, as the case may be. They are claims against a business organization. And the last one is capital. Capital represents the owner's investments in the business. Whatever the owner has contributed to the business is what is referred to as capital. So let us consider the format of the statement of financial position. Like in the format of the comprehensive income statement, we have the headings. So the headings will normally carry the name of the account, in this case, Oluwafemi, then the statement of financial position as at year end 31st December 2022. You can see the statement of financial position is showing us as at a particular date. But if we go and look at the statement of comprehensive income, that one will be financial statement of income for the year end. So why this is statement as at 31st December. So the first item that we normally have there is the current assets, the non-current assets. The first thing we have there is the non-current assets. Now, for non-current assets, we are aware of non-current assets that we have. The non-current assets that we have include furnitures, motor vehicle, building, premises, office equipment. All these are non-current assets. So we have them at costs. If they have depreciable value, we deduct the depreciation value. But if they don't, that means the cost will be equal to the net book value. So that at the end of the day, we have a net book value. Then the next thing is to determine the current assets. The next thing is to determine the current assets. Now, how do we determine the current asset? So let's consider current assets. Current assets are assets that are used up within a particular period. They change frequently within a particular period. Like I said, if you watch the video on accounting equations, you'll be able to understand the meaning of current assets. So the current assets consist of our closing inventory, if we have cash or bank, prepayments, and account receivables. Now, all these accounts, they change frequently as the organization enter into different transactions. So at the end of the day, we sum up all our current assets, we add it to our non-current assets, we will now have what is called the total assets. Now, the next step will be to determine our equities and liability. For equity and liability, for non-current liability, we might have bank loan that extend beyond one accounting year. We might also have deferred taxes. All these deferred taxes represent taxes by an organization or an individual that has been carried to another period. while our current liabilities are liabilities or obligations that we are supposed to fulfill in the current accounting year. So this may include bank overdrafts. If you run a current account, you may be allowed to overdraw your account to a particular amount. There might be other owings that must be settled within the accounting period. That's within the period of preparing that particular account. Then the last one is account payable. Account payable represents the value of goods that suppliers have probably supplied us and we are yet to pay for. So at the end of the day, we'll have the total liability. Then we now have our equity. Equity consists of the capital of the business, and you add your net profit, the net profit that will be derived from the statement of profit or loss or the comprehensive income statement. If there are any drawings during the year, if the individual has made any withdrawal, it will be taken out of the capital account, and as such, we now have the total figure. So if we had our total equity and total liability, we would get the same figure as our total assets. So if you have watched the video on accounting equation, that should be self-explanatory. So that should be self-explanatory. So let's continue. So I hope you've been able to understand some of the concepts that we have here. Now for the formats, you need to learn the formats. You need to be able to reproduce the formats before you can solve any question. So let's look at this question. Okonkwo trial balance for the year is this. So we have our sales value to be 38,500. We have purchases 29,000. We have rents 2,400, lighting and expenses. You have general expenses. You have fixtures and fitting. That's an asset. Now there are some of these transactions that are balance sheet transaction, that's statement of financial position transaction, while others are income statements transaction. So if you follow the exact formats that we've just looked at now, you should be able to prepare an income statement and a statement of financial position. So the requirement is you have been given the trial balance of Okonkwo and Son draw up as at 31st December 2013 after the completion of the first year in the business. The closing inventory was valued as 3,000. The closing inventory will always be given to you as an additional information. You are required to prepare the income statement of Okonkwo and Sons for the year ended 31st December 2013 and the statement of financial position as at 31st December 2013. So using the formats that we had before, if you use the format that we had before, you'll be able to prepare the income statement. So you have your sales. There was no sales return, so our net sales will still be our sales. We have our cost of sales. There was no opening inventory, so we'll subtract purchases. We'll subtract the closing inventory from purchases since there was no opening inventory. So when there are items that are not in the formats, you just use the format the way it is. Then you now have expenses. So you add all your expenses, deduct from your gross profit, and that will give you the net profit. Then we now have the statement of financial position using the information that you have in the trial balance. The majority of what is here would be given naturally. So you have your furnitures and fitting 5,000. That's the only non-current asset that we have there. So our total non-current asset is this. Now, this is considering the fact that there was no depreciation during the year. So this is just a simple format. Then we have our current assets. Current assets include inventory at the end of the year, don't forget. Then our account receivables. Account receivables, another name for account receivables is debtors. You have your cash in bank. At the end of the day, our total assets is 3,100. Then we now have our equities and liabilities. So you have capital, introduced 20,000. Our net profits, that's net profit we made in that year, is 8,000. That will give us 28,000. Well, less the drawings that have been taken out of the business by owner, that will give us 21,000. Then our liabilities. We don't have non-current liabilities. We have current liabilities. So under that, we have our accounts payable of 9,100. If you add that to the 21,000 on our equity account, if you add that together, you see you'll get the same value as your total assets. So that's that about statement of financial position. So this is an assignment that you're supposed to do. So try hands on the assignment, submit it at you can submit it. You can submit it. You can submit it once you are done. Yeah. So don't forget, failure is the ability to start again more intelligently. And your mindset is very, very important. Numbers don't lie. If you work out for 30 minutes every day, you cannot compare yourself with somebody that works out for 3 hours every day. Results would always show. So you can reach me on any of the social media platforms. Please remember to subscribe and like my videos. Thanks for watching. I'll see you in my other video. So